You walk into a bank and deposit $10,000 into your checking account. You probably think that money just sits there, safely waiting for the day you decide to spend it. But that's not what happens. The moment your money enters the banking system, it starts moving. It may be helping someone buy a house. It may be funding a business loan. It may even be supporting investments worth hundreds of thousands of dollars. And while your money is moving through the financial system, the bank is making money from it, a lot of money. In fact, some of the largest banks in the world generate tens of billions of dollars in profit every single year. So how do they do it? How can a business that stores money become one of the most profitable industries on earth? The answer lies in a system that most people use every day, but very few actually understand. This is how banks really make money. When most people picture a bank, they imagine a giant vault filled with stacks of cash. But modern banks aren't in the business of storing money. They're in the business of moving money. Banks exist because different people have different financial needs. Some people have money they want to save. Others need money they don't currently have. Banks connect these two groups. They take deposits from savers and lend those funds to borrowers. At first glance, the process sounds simple, but this simple idea became one of the most powerful business models in history because banks discovered something incredibly important. Most customers don't withdraw all of their money at the same time, and that changes everything. Let's say you deposit $10,000 into your account. The bank doesn't put your money into a vault. Instead, it keeps only a small portion available for withdrawals and uses the rest to issue loans. A family might use that money to buy a home. A student might use it to pay for college. A business owner might use it to expand a company. In other words, your deposit becomes productive capital. And this process happens millions of times every day. This system is known as fractional reserve banking. For centuries, it has been one of the foundations of modern economies. But the real question is this: where does the profit come from? The answer is surprisingly simple: interest. Imagine the bank pays you 2% interest on your savings account. On a $10,000 deposit, that's $200 per year. Now imagine the bank takes a portion of that money and lends it to someone buying a car at 7% interest. The borrower pays much more than the bank pays you. That difference is known as the interest spread, and it is one of the most important sources of revenue in banking. The larger the spread between what banks pay depositors and what they charge borrowers, the more money they make. It sounds small, just a few percentage points, but when you're dealing with hundreds of billions of dollars in loans, those percentages become enormous profits. This is why interest rates matter so much to banks. A small change can mean billions of dollars gained or lost. Few products are more valuable to banks than mortgages. Think about it. A typical American homebuyer might borrow $400,000 to purchase a house. The loan could last 30 years. Over those 3 decades, the borrower may end up paying hundreds of thousands of dollars in interest. For banks, mortgages create a predictable stream of income that can last for decades. One mortgage may generate revenue for years. Millions of mortgages can generate fortunes. This is one reason banks compete so aggressively for homebuyers. A mortgage isn't just a loan, it's a long-term business relationship. If mortgages are profitable, credit cards are on another level entirely. Every time you swipe a credit card, multiple parties may earn a small fee. The merchant pays a processing fee, the payment network takes a cut, and the issuing bank receives a share as well. But the real money often comes from interest. Many credit cards charge annual interest rates exceeding 20%. If a customer carries a balance month after month, the interest can grow rapidly. Across millions of cardholders, those interest payments generate billions of dollars in revenue every year. This is why banks invest heavily in rewards programs, cashback offers, and travel points. The goal is simple: get customers to use the card more often, because every swipe creates another opportunity to earn money. Interest isn't the only source of revenue. Banks also earn billions from fees: monthly account fees, wire transfer fees, overdraft fees, ATM fees, foreign transaction fees, late payment fees, loan origination fees. Individually, these charges may seem insignificant, but when collected from millions of customers, they become a major source of profit. Some banks generate billions of dollars annually from fees alone, and because many customers barely notice these charges, fee income has become one of the industry's most reliable revenue streams. While consumers focus on checking accounts and credit cards, the biggest banks operate in another world entirely, the world of investment banking. When a company wants to go public, raise billions of dollars, or acquire another company, banks often step in to manage the process. For these services, they charge enormous fees. A single merger between major corporations can generate tens of millions of dollars for the banks involved. Some deals generate even more. This is where banking stops looking like a neighborhood branch and starts looking like high finance. Behind the scenes, banks help move massive amounts of capital throughout the global economy, and they get paid handsomely for doing it. Banks advertise constantly. They offer sign-up bonuses, high-yield savings accounts, credit card rewards, cash incentives, all because deposits are incredibly valuable. Your money gives banks the fuel they need to make loans, invest, and operate their business. To a bank, deposits are inventory. The more deposits they attract, the more opportunities they have to generate profit. That's why banks fight so hard for customers. They're not just competing for accounts, they're competing for capital. Of course, banking isn't a guaranteed money printing machine. What happens when borrowers stop paying? What happens when housing prices collapse? What happens when the economy enters a recession? Banks can lose staggering amounts of money. The 2008 financial crisis revealed exactly how dangerous the system can become when risks are underestimated. Some banks failed, others required government bailouts, and trillions of dollars were wiped out from the global economy. The same system that can create enormous wealth can also create enormous losses. That's why banking is one of the most heavily regulated industries in the world. At its core, banking is built on a simple idea. Take money from people who have it, lend it to people who need it, charge more interest than you pay, collect fees, provide financial services, manage investments, and repeat the process at a massive scale. What looks like a simple checking account is actually part of a financial machine, moving trillions of dollars every day, and every dollar flowing through that machine creates opportunities for banks to earn money. The next time you log into your banking app or deposit a paycheck, remember this: your money isn't just sitting there, it's working. And somewhere in the background, your bank is working very hard to make money from it.